Okay, the GST/HST. So just to be clear before I say anything at all about the GST and HST, I use the terms GST and HST interchangeably. They are essentially one tax, two forms of a single tax. It's just dealt with slightly differently in different provinces, but really the rules that I'm going to tell you about right now are identical for both GST and HST. So while I try to use both terms every time, sometimes I will just slide over and say either GST or HST. If you are thinking, oh, wait, but they don't have that tax in my province, it's GST, not HST, or in my province, it's HST, not GST, rest assured that whatever I'm talking about relates to both, in case I get lazy and start just referring to one. Let's define our terms. The GST is a goods and services tax. So it is a sales tax at the federal level charged on goods and services. So on money that changes hands because one person is passing over money in exchange for a good or a service. And there's a federal sales tax on that. PST is the provincial sales tax. Some provinces have a separate provincial sales tax and some don't. But PST is the provincial part, as a provincial sales tax. And some provinces have combined the federal sales tax with the provincial sales tax into a single tax with one set of rules, which is the HST. So the idea behind the HST is that it really cuts down on administrative headaches, because in provinces that have the GST and the PST, there are different rules for when you collect it, the form that you have to file to report it, the deadlines, how you report it. There are two sets of rules and you have to know them both if you're registered for both these taxes. But in a harmonized province, such as Ontario or the Atlantic provinces, there's only one tax and there's only one rule that apply, or one set of rules that applies to everything. So as you see, the GST is part of the HST, and that's why when I say HST or GST, I'm talking about the same thing, because they're subject to one set of rules. And finally, if I use the term supply, or if you see the word supply in anything that you, if you reference the Canada Revenue Agency's website and you see them talking about supply. Now you as a musician don't think of what you do as a supply, but it is, because in the realm of tax talk, the supply is either a good or a service. It's just whatever is being exchanged for money or other objects of value. So when you go and you play a gig and you get paid, that gig was a supply. You supplied it. So do you even have to concern yourself with the GST/HST system? Well, a lot of you know about the $30,000 rule, which I'll reiterate. If you earn $30,000 of freelance gross in a year, it's time to register for the GST/HST. So some refinements here. So only your self-employment income matters here. If you have a salary job on top of your self-employment, only the self-employment income counts toward this $30,000 limit. Second, it has to be earned within a 12-month period. That does not necessarily mean that it's confined to a calendar year. So for example, if you get two $15,000 gigs, one in December for Christmas and one in January for New Year's, and you're saying, well, it's 15,000 in one year, it's 15,000 in the other year, therefore I didn't cross the $30,000 limit. Yes, you did, because you crossed it in the space of 12 months, 12 consecutive months. The rule is actually a little more nuanced than that, but that's the basic rule. And because the 12-month period that we're talking about can span 2 calendar years, what this means is that you always, whatever point in time you're standing at right now, you have to look back over your shoulder 12 months and see if you cross that line. So at any given time, if you look back at your 12 months billing, did you cross the $30,000 line? Yes, then you must register for the GST, which means that you're going to call the Canada Revenue Agency, get a number, and start charging it. You do not have to go back. If it's time to charge, you don't have to go back and charge from before, okay? You cross the line when you pass that $30,000 mark, then you register, and from that point forward, you charge GST or HST, depending on the province of the payer. You do not have to retroactively charge it or pay it or anything like that. Excellent question right here. Does private teaching count toward the $30,000 cutoff? And because you are musicians, you are talking about music lessons, which is very specific. Music lessons are one of the few things in the world that the Canada Revenue Agency considers to be exempt from the GST/HST system. Exempt. And by exempt, we mean no, they do not count toward the $30,000 limit. We will be talking a little bit more about special kinds of income and what counts and what doesn't count, but music lessons do not count toward the $30,000. Specifically music lessons. If you taught anything else, like, you're here because you're orchestral players, if by some chance, I don't know, if you're teaching, I don't know, bookbinding or something, that actually is not exempt. Only music lessons. So anything other than music lessons, teaching any kind of teaching other than music lessons does count toward the $30,000, but music lessons don't. So I'm going to explain the entire GST/HST system in a single slide. And here it is. Once you become a registrant, you become part of the GST/HST system. At that point, you must start charging it. The amounts that you charge to your payers are not yours. The GST or HST that you add on top of your fee does not belong to you. It is a tax that you have collected on behalf of the government, and it belongs to the government, and ultimately you're going to send it to the government. On the other hand, if you're living and working in Canada, chances are the expenses that you're spending on your business also include GST or HST. When you bought your instrument, there was GST or HST on it if you bought it here in Canada. That GST and HST, which you used to just write off, now instead of writing it off, you're going to get it back, which is better. Trust me, mathematically, it's better. So this is the way it works. Being registered for the GST means, first of all, that the GST is added on top of your fees and collected from the payer. And second of all, that the GST that used to be embedded in your expenses is now going to be separated out and collected back from the government. So I see a question here. I'm going to see if now's the time to answer it or if I'm going to answer it a little bit later. All right. Okay. I've been a GST registrant for several years now, but as I've been getting closer to approaching retirement, I don't make anywhere near $30,000 per year, and I never will again. Is there an advantage or disadvantage to deregistering, becoming a non-GST dude? Can one ever even do that? Okay. In a moment, I'm going to explain why there is always a financial benefit to being registered. There is a financial advantage to being registered. However, the less money you earn and the less money you spend on your business, the smaller that advantage gets. So only you can really judge if it's worth it. Depends on how much you hate paperwork, really. And the other thing to consider is, now when you are being paid by an entity, generally they are also registered for the GST, which means on their end that if you charge them GST, they are going to claim it back from the government. And therefore, when you're billing an entity, they don't care if you're charging HST on top of your fee, because they know that it's not actually coming out of their pocket. They're going to get it back. But when you are charging an individual, like you're working a wedding or a funeral, and it's a person who's hiring you, you have to charge the GST and HST to them too if you're registered. And that automatically makes you more expensive than a non-registered musician. So if you are dealing directly with individuals, there may really be a disadvantage to being GST registered. And if you don't have to be, you might consider, closing your account. On the other hand, if that's not the case, if generally you are paid by entities, or that the people who pay you want you regardless of GST or not GST, you're not competing on price because that's not the way you roll. So there's no disadvantage in that case for you being registered. You are at a financial advantage to be registered. And here is why. When you're not registered, you basically bill your fees, and out of your fees, you pay your business expenses. Those are gone, and what's left over is your profit. Done. When you're registered, you have your fees, you're billing GST or HST on top of those fees, and you are spending GST inside of your expenses, right? Because you always have to, when you go to Staples, you have to pay them the GST up front. It's embedded in your costs. So when it's time to file your return with your GST people, you are going to, well, okay, so there, you've spent your money on your expenses and your GST. You give the government the GST that you collected on top of your expenses, and they give you back the GST that you spent on your expenses. Sorry, you give them what you collected on top of your fees, they give you back what you spent on your expenses, and that becomes your profit. So the profit is a little bit bigger if you are registered. And this is mathematically always the case, because the amount that you remit to the government is always an amount that you collected straight from the client. It's not your money, it's their money. And meanwhile, the money you get back is the money that you had to spend on your expenses and you would have spent either way, only now you get it back because you're registered. So you have to, if you're deciding whether to register or deregister, if you don't make the 30,000 and you're trying to decide what's better, you really have to decide how much, income am I potentially losing because I'm registered and individuals don't want to pay this GST because they don't get it back, versus how much am I getting because I get to write it off and claim it back on my expenses. So the financial decision is in there, tempered a little by how much do you hate filing your GST return. Because as long as you are registered, you must be filing GST returns on a regular basis. Even if you make no money, if you're still registered, you have to file a nil return. You have to keep the government informed of what you're doing with your GST once you're registered until you close that account. So there's always paperwork involved. Excellent question here. Do you get your GST back on CCA items? GST/PST back on CCA items. I don't know about how the PST works in your province. Yes, you get the GST back. And if you're in a harmonized province, yes, you get the HST back. And unlike the expense, the underlying expense that is spread out over years, you get it back right away. You get it back in the year that you spend it. So let's say that you're here in Ontario, you spend $1,000 on an instrument, they charge you $1,130 because you're paying 13% HST. In the year, you will get the $130 of GST, HST back on your GST account. And then what's left is still the underlying cost of the instrument, and that you're going to write off gradually. Whereas if you were not registered, you'd have an expense of $1,130. You would get to write off the whole thing, but that is not, it doesn't actually do as much good for you as claiming back all the HST. Okay. Thank you. You're welcome. Does a GST registrant need to keep track of and declare the actual GST portion of claimed expenses, or is it simply calculated by the CRA on the total expense amount? Yes, you have to calculate it. Yes, you have to calculate it, because you may have purchased something that doesn't have any GST because you bought it in the States. You may have purchased something in another province where they charge GST when you live in an HST province, or they charge HST when you live in a GST province. There is no way for the government to know, just looking at your expenses, how much you spent on GST and HST. It is your responsibility to keep those separate. That said, here at Personal Tax Advisors, because a GST registrant, in order to accurately even report your income tax correctly, we must make sure that the GST and HST is not interfering. And so we have to split it out. We do that as part of the process. And because we do that as part of the process, we actually calculate and file your HST, GST return free of charge. Like if you come to us for self-employment, we're doing the same calculation anyway. We just throw in the GST return for free. And we do it with math generally. But just so you know, yeah, we split things out, or with your help, your information, we split things out for you. And we put the amounts that belong on the GST return on the GST return, and the amounts that belong on the income tax return on the income tax return, because they shouldn't really, generally, they don't cross over. Sorry, I answered that. Can you speak about the quick method for calculating GST, HST? Nobody has ever asked me this. The quick method is actually not quick from the perspective of me, your friendly neighborhood tax preparer, because it's a pain in the butt. But basically the way the quick method works is you, instead of keeping your GST and your HST separate, you actually, and instead of claiming back the GST or the HST on your expenses, what you do is you take the full amount that you billed You ignore your expenses, the full amount that you billed, and you give a percentage to the government. The percentage is set by the government. So what they've done is they've looked at many, many businesses, and they figured out generally how income to expense ratios tend to fall out. And they've sort of just calculated for you. Yeah, you'd probably, on that income, doing what you do, you'd probably have to give us 8.8%. So give us 8.8%. And that's the quick method. There's a little more nuance there, a little bit more, but it's, for me to explain it with no charts would be so confusing to people who aren't really doing it. That's the thing. One thing about the quick method is, if you want to use the quick method, like you're doing your own taxes, it is a simpler calculation slightly. If you're just doing broad strokes and you're doing your own taxes, maybe you have to elect for it, which is to say that by default, you're not on the system, you're not allowed to use it. You fill out it's not even an application, it's just I want to go on the quick method. You can go through My Business Account, or you can call CRA and just switch, and they will set you up as quick method, and then you file as quick method for at least 1 year. If you don't like it, you can switch back, but anytime you make a switch from the quick method to the long, or from the long to the quick, you have to stay on it for a year before you can change back. I hope that answered what you wanted to know. Okay. I just moved to Quebec. I used to live in Ontario. I remember HST filing was quite simple. Do I now have to file the QST and GST separately? Oh dear. It depends on whether or not, and this requires no knowledge of a provincial sales tax. I am an income tax person, and therefore, and a federal tax person mostly. So provincial sales tax is where I am not 100% versed on exactly the rules. So I'm not going to get precise about the rules. If under the Quebec rules, you must charge Quebec provincial tax, because it's separate. Everything about Quebec is separate. Then you may have to file a separate return for that. I don't really know what their rules are about the sales tax, but generally, most people are just filing a single return. And I think the QST return is actually the only return that just combines, your PST and your GST. It's so weird the way they calculate the GST there as well. I'm sorry, this is just one of those things where I think you're going to have to ask them, and ask them in French if you can, because anyway, if it's a separate sales tax, they might have a separate filing thing. But I don't actually think that they do. I think they actually have combined it into a single form, but it's still two calculations. You end up having to keep both figures completely separate, because I actually do work these numbers for a client of mine, and come to think of it, no, they are separate returns. Yep, they are separate returns. I have done this. They are separate returns. They look the same, and like they're laid out the same, and all that's changed is that the box number on the GST is 101, and the box number on the QST return is 201. But they're different, because some things have GST and not QST, and some things that you purchase in another province have neither. And they're separate returns. We also calculate those on the fly when we do this. So I'm sorry, it's not as simple. It is still, the process is the same, but it's two. You got to do it twice with two sets of numbers. Do I need to change my common law partner HST? We work together and supply services to each other. Do I need to charge it? Sorry, do I need to charge it? We work together and supply services to each other. If you have semi-formalized this process of paying your partner for something, so that you are writing off that cost in your income tax return, and they are declaring that income on their return, then yeah, she has to charge you, or he or she has to charge you GST or HST, depending on the province that you're in, and you have to pay it and claim it back. And but there are a lot of situations where partners who are exchanging services don't, if you are writing off the cost, they must declare the income. If she's not declaring the income, then you can't write off the cost. So if you're doing it informally, nobody's reporting anything, then no, you don't have to do the GST. But if you're doing it formally, that she is declaring the income and you are writing off the cost, then yeah, HST must be charged. There's no special rule that says you don't charge it to your spouse. Okay, another question. When I registered for the GST, they asked me if I wanted to file annually or quarterly, and the agent I spoke to said there was no difference. Do you have any insight as to whether one might make one better than the other? Yes, annually is better. I'll tell you why. The filing period is how often you have to basically send the government a report as to what you're doing with your HST. To me, filing quarterly is just doing this job 4 times when you could just do it once. Now, a lot of people think that if they file quarterly, that means that they're avoiding a problem of having the GST or HST that they're collecting kind of pile up and they don't know what's theirs anymore and so on. Well, for one thing, and we'll talk a bit later about this if we get that far, you should be setting that money aside anyway. Like any GST or HST you collect, you should be setting aside anyway. It shouldn't really matter. Second of all, filing is not the same as paying. Filing is just reporting to the government what you're doing. Filing that return generates a tax bill, which you then pay. So in terms of what you're going to remit in GST, it's exactly the same. Basically, if you file quarterly, you have essentially one quarter sort of your figures are on one return, and then another quarter on another return, and another quarter on another return, and another quarter on another return. 4 pieces of paper you have to file, 4 deadlines you have to be aware of, 4 times you have to stop and do this calculation, as opposed to annually. 1 deadline that you have to know, 1 piece of paper you have to file, 1 calculation that you need to do. So I really think annual is better. Basically, the way it goes is that the more money you make, the more frequently they want to hear from you. If you make there is a point where you must file quarterly or more often, and that is a point where your revenues exceed $1.5 million. At that point, they're going to want to hear from you quarterly. But as long as you're not making 1.5 million, go ahead, opt for the annual and file once a year. And the other nice thing about the annual is the quarterly ones are due at in April, and then another one is due in July, and then another one is due in September, and then another one is due in January. If you file annually and you are a sole proprietor, meaning you're not a partner and you're not a corporation, it's just you, the GST return, the annual return, is due exactly the same day as your tax return. Easy. That's one less thing to remember. So annual, better. Is it legal to pay your spouse informally? Yeah, it's called like giving them some money. I pay my spouse informally all the time. Every time he runs out of money, I pay him informally. Yeah, of course it is. What's not legal is for you to write it off and her to not declare it as income. That you get a tax break for paying her, but she doesn't pay the tax burden for doing the work. So the rule when you're paying a spouse or a dependent child, anybody that you're related to, the rule is that you must pay them an amount. Like if you're actually gonna write it off on your taxes and have them declare it as income or whatever, there can be tax advantages to this, particularly if the other person doesn't make any money other than what you pay them. It can help you spread out income. It can be useful, but you're not allowed to pay them an amount that's higher than what you would pay a stranger to do the same job. So make sure that you have a little note indicating if you are paying them and you're writing it off and they're declaring it as income, make sure that the amount that you are paying them makes sense and that you have a little calculation where you show that it makes sense, and you're going to hang on to that in case CRA ever asks to see it. We'll talk about records in a little bit. Okay. Done. All right. If you are back to the HST, if you are doing some work for a payer who is not here, so you're going to be doing some work for a gig in Berlin or in the US or whatever, how does it work if you're HST registered? Well, first of all, you don't charge them the HST. They are called 0 rated. You don't charge it to them. However, on the upside, you still get to claim back the GST on the expenses relating to that work. So if you decide to play a gig in Philadelphia, you are not charging them HST. And if you take the train to Philadelphia and there was $100 of GST or HST on that train ticket, you still get to claim back that GST or HST And so you remit, on this particular job, you would remit 0, but claim back $100 of GST. So you'd actually end up with a refund of GST based on this, based on working for a client who's not in Canada. You charge GST or HST to Canadian payers and Canadian payers only, and you pay, and the rate that you charge them is not the rate in your province, it's the rate in their province. I'll say that again. When you are performing a service for somebody, even if your butt is still at home, you charge according to where the payer is located. Okay. And in the case of an American or European payer, they are located outside of Canada. So you charge them what they're supposed to pay, which is nothing. Music lessons are exempt. Hey, so we've already been through this. You don't charge HST on them, but you cannot claim back the HST that is related to expenses that are just for music lessons. So you have a smaller profit on that one. So it's kind of like, yeah, that shouldn't have come back to you because that's not the way that works. Okay. Now, what if you just don't want to be registered? You're not making $30,000, you don't have to, and you don't want to because you don't want to do the paperwork, or you are over $30,000 and you know you should be registering, but you don't want to. I will give you a warning: if you are over 30,000 and you don't register, nothing will happen at first. Eventually, the Canada Revenue Agency takes a look at your income tax returns, sees that you are grossing over 30,000, notes that there is no associated GST account, and wants to know why. And if the reason is that you just didn't feel like registering, you're in trouble, because what they will do is they will back register you. Maybe 3 years back, I've seen this happen. They go and say, okay, you should have registered in 2018. And we want all the GST that you were supposed to be collecting all that time, please hand it over. People are always asking me about how not to get audited, and they're always concerned about this. They're not as concerned about the fact that they don't register for the HST when they should. While the timing, the exact timing, there are rules about exactly when you have to register for the HST, but the exact timing isn't really the issue. Just register when you're in the ballpark before they notice. So you can be a little late registering as long as you notice that you should have registered before the Canada Revenue Agency notices that you should have registered. So if you are over 30,000, absolutely register the second that you notice that. Register. It doesn't matter that you're 2 years late. CRA hasn't noticed yet. A year from now, they might notice. But if you've already registered, by the time they notice, they'll leave you alone. Now, if you're under 30,000, so you don't have to register, and you don't want to register, let's say, okay, fair enough. But one thing I'm going to point out about this, there are two advantages to being registered, whether you need to or not. The first, register, we've discussed. There's a financial advantage to being registered. The second advantage is nobody knows how much you bill. Sorry. Because the problem is that any payer in Canada who's like an entity, like a company, they know that the $30,000 rule is in force. And when you issue an invoice, if you are registered for the HST or the GST, you have to put your HST or GST number on the invoice, and you have to show the HST or GST that you're charging on its own line. In other words, an invoice from a registered person is visually obviously different from one from a non-registered person. So anybody looking at your invoice immediately knows whether you're registered or not. If you're not registered, they can infer from that you don't make $30,000 freelance, and that may be something you don't want them to know. So if it's none of their business, or if you think that it's going to hurt you in some way for them to realize that you're, not making $30,000 self-employed, you can hide that by being registered. So that's another thing to take into consideration. Now, I do have a great resource about this, a primer that it's about 10 pages long, and at least one of those pages is just charts. So it's not a whole lot of text, and it's not closely written or anything. It's just a quick lickety-split handbook. And it'll tell you kind of everything that you need to know for the GST pretty much for your whole career. There's like almost impossible for you doing what you do to encounter an issue that isn't covered in this little booklet. So it's really a great little resource to have handy. And I'm going to add the I'm going to put the link right in the chat. I see that there's a question in the chat too, which I will address in a moment. So there's a question in the chat, which is, should private music teaching income be declared separately from performing income? Should I fill out separate T2125 forms? That is the profit and loss statement that goes inside your tax return for each. No, you can put it all on the same T2125. You can put it all as part of your self-employment income. It just doesn't trigger an obligation to register for the HST. And it doesn't affect your HST collected or anything like that. It doesn't affect anything, but it does not have to be separated out. These are really two different returns, and it's just these two kinds of returns treat this income differently. If you make $30,000 across multiple income sources, not including music teaching, does that still qualify to register? If all those sources are self-employment, yes. As a sole proprietor, you and the work that you do for freelance pay are a single entity. It doesn't matter how many different types of things that you do. It's still, you are in the business of being you and selling your services. If you are selling your services for more than $30,000 per year, not counting music lessons, anywhere in the world, if it's freelance $30,000, yes, it all counts toward that $30,000 limit. Do I have another question about the GST before we move on? Okay. Again, we may have time. I'm prepared to go until 4:30 here. So, I mean, I'm sorry. I'm going to try to finish before that, but lately it hasn't really worked out that way. So, I will try to finish the slides before 4:30, and then we'll finish up with some Q&A if there's anything that's been missed or forgotten. Let's talk very, very briefly about special kinds of income. One is income outside of Canada, which we have actually already discussed. Income outside of Canada is taxable on your Canadian return. It is part of the $30,000 GST limit. It counts toward that limit. But it is like being paid by an American. It is zero rated. You don't charge them the HST, and you can claim back the GST or HST on expenses related to that income. If you work for an American payer, they may ask you to complete a form called a W8Ben. Go ahead and do that. What the W8Ben does is the payer in the US may be obliged to withhold US taxes against your income that they pay you unless they have the W8Ben. So the W8Ben is essentially, it's actually, when you break it down, if you look at the form and really read what it's asking for, it's a very simple form that essentially has who are you and where do you live and why do you not have to pay taxes in the States, which you would say, because I'm not an American citizen and I don't live in the United States. So that's what the W8Ben states. And what it does for the payer is it gives them the right to not withhold US tax on your income. And that's what you want. Trust me, you will, even though we're not supposed to have double taxation, the way that the mathematics tends to work out, and certainly the way the administration works out, is it does cost a little bit more if a foreign country is withholding tax and you're filing Canadian taxes. It's not supposed to, and it's not a ton, but it's there. It's a little more expensive if you do it that way. So if at all possible, you want your foreign payers to not withhold any tax for you. The W8Ben is what will allow that to happen, at least with your American payers. Okay, I see. There's a question regarding exactly this. Is there a way to get tax withholding back from American gigs? Usually they take 38% even with the W8Ben. They're really not supposed to. The whole purpose of the W8Ben is to state that you pay taxes in a foreign country with whom the Americans have a treaty, and therefore they don't have to withhold tax. If they are asking for a W8Ben and withholding tax, they don't know what they're doing. That said, short of actually filing an American tax return, which is going to be expensive and onerous, the way that you get your money back, you don't quite, is on your Canadian return, you make what's called a foreign tax credit claim, or we call it an FTC. So there's a schedule that you can add to your return that basically says, I made this much money in the US, this much tax was withheld. I would like a credit for that. I would like my Canadian taxes reduced to make up for that. And this is the process by which we mostly avoid double taxation. that you get to say, I already paid this tax in a treaty country. And the CRA says, okay, we'll reduce your income tax. The problem is it's usually not a dollar for dollar, and the CRA is stingy. So maybe they withheld $300. You file your FTC claim, you say they withheld $300, and CRA says, okay, we'll give you credit for 250 of that. You still have to pay the extra 50. So you're basically getting taxed a little bit more. So this is why the ideal situation is just to not have them withhold any tax, because while you can get a credit for the tax withheld, it's never quite dollar for dollar. In my experience, it's never quite worked out that way. Supposed to, but mathematically it's set to err on the side of caution, and you end up paying a little more tax. If a venue doesn't send you a W8Ben, can you just send them one so they don't take the withholding? I would say ask them if they know how to handle it, you know, because if you're dealing with a venue or an entity that doesn't understand this stuff, you can send them the form, but they're not going to do anything with it. So ask them, you know, ask them, would it help? Like, are you planning to withhold US tax? If yes, would it help if I gave you a W8Ben? Would you, you know, would you just not do that, please? And see what they say, because you might be filling out a form for no point, to no purpose. All right. What if you lived, okay, another question. What if you lived in the US for a couple of months while gigging there? It depends on where your home base is. I'm hoping that your home base stayed here in Canada. If your home base is in Canada and you are temporarily living in another place in order to do a gig, you are still considered to be a tax resident of Canada. Residency rules can be really complicated, but they boil down to, where is your home base? They include things like, where are you physically? But they also include things like, where is your home? Where is your stuff? Where do you have where's your driver's license made out to? Where's your library card made out to, right? There's a bunch of little things that sort of establish where your home base is. So essentially, if you move to the US, you didn't pick up and move kind of your whole life. You just sort of domiciled there. You just sort of sojourned there for a while, and it was for less than 6 months. You're just going to file your Canadian tax return as usual. And I'm hoping that the Americans did not withhold your tax on that income. Briefly, we're going to talk a little bit about grants. The most important thing to remember about grants is there's several important things to remember about grants. One is that if you're using software to do your taxes and you have a T4A from the Canada Council with income in box 105 for your grant, the software is going to throw that on line 13,000, 13000, other income. That's where the software is going to automatically slot it, but you have another option, and I want you to take it. The other option is you put it as part of your self-employment gross. You remove it from other income and you place it on the profit and loss statement T2125. The reasons are multiple. One is because if the grant is a project grant, so it's designed to cover the expenses for a project. In other words, it's meant to be completely used up. You need to be able to write off those expenses against that grant income so that you don't ultimately pay any tax on that grant, right? If the grant was for $4,000 and your expenses were $4,000, if you leave the grant on line 130, you're going to pay tax on $3,500 anyway. You don't want to. You want to be able to write off the full expenses. You can't write off expenses against income that isn't showing up on that same form. So in order to write off the grant expenses, you must put the grant income on your self-employment statement. And that will ultimately mathematically work out so that you're going to pay less tax on it. And second of all, if there is any of this grant that you're actually getting to hold on to, so for example, the grant had a living allowance in there, or the expenses of the grant didn't actually meet the cost of the grant, so you ended up keeping some and it's taxable, it'll count as being pensionable as well. It's treated, by moving it to your self-employment income, it's treated as part of your business. And that has a couple of effects, one being that you get to write off your expenses, and the other one being that you get to contribute to the Canada Pension Plan, which at this moment, you may not want to do that because it's extra money out of your pocket. But When you retire, the amount of pension that you get from the Canada Pension Plan really is related to how much you've paid in. And you will get more from the pension plan than you have paid in. So you really want to pay into it if you have a chance. Especially in the modern day and doing what we do, you may not have any other pension other than the Canada Pension Plan. So you want to contribute to that pension plan. And by moving this income over to your self-employment, you get to do that. So I really want you to put it there. Take it off of other employment, put it onto your self-employment, please. Also, it's not actually, I should say, sorry, it's not actually subject to the GST or HST either. Remember that we said that the goods and services tax is for the exchange of goods or services in exchange for money. A grant doesn't have that exchange, right? They give you the money, they don't actually get what you produce. They don't own it, you know? If they give you the money to produce a concert, they don't own the concert. They don't get anything out of the concert. They don't even get the proceeds from the concert. So it is not actually the exchange of a good or a service, and therefore it's not part of the GST system. It's actually exempt. Being exempt, it's like music lessons. There's no GST included in that grant amount or added on top of it. It's completely separate. But in theory, the expenses relating to executing that grant, you cannot claim back the GST on those expenses, only on the expenses that relate to your GST taxable income. Cash payments are taxable. They must be reported, and they must also, if you are registered for the HST, whatever you collected in cash must be treated as if it also contains a certain amount of GST or HST based on your percentage. So you will not, so if you get paid, again, for simplicity's sake, let's say you get paid $100 for a gig and you are in Ontario and you're registered for the HST. If you got paid $100, you do not have to give them $13 on top of that back to the government. But you will split that $100 into about $88.75 plus $11.25, I think is how it works out, where it's $88.75 plus HST. So the amounts will be split of the cash amount, so that you'll end up reporting part. You use math to end up reporting part of the income as income and part as HST that you're going to remit to the government. There's another, yeah, so that's just gone from you. Yeah, so that's how cash payments are treated. Any other questions before we move on to the question of setting aside money for tax?